Hey traders, welcome back to the channel. Today, we're breaking down a term you've probably heard a lot, leverage. What is it, and how can it impact your Forex trading? Let's dive in. So, what is leverage in Forex? Think of it like this. Imagine trying to lift a heavy rock. Pretty tough, right? But if you had a long lever, it'd be a lot easier. Leverage in trading is kind of like that. It allows you to control a large position with a smaller amount of money. In Forex, leverage is provided by your broker. If you have $100 and use a leverage of 1 to 100, you can trade as if you had $10,000. That means you can open larger positions than what you could with just your own money. Let's break it down with an example. If you want to buy EUR, USD, and the price is $1.10, without leverage, you'd need $1,100 to buy 1,000 euros. But with 1 to 100 leverage, you only need $11. Cool, right? But hold on. While leverage can amplify your profits, it can also amplify your losses. If the trade goes against you, you could lose more than you initially invested. This brings us to the risks. Higher leverage means higher risk. It's like driving a sports car. Fun when things go well, but risky if you're not careful. If you don't manage your risk properly, you could end up with a margin call, where the broker closes your positions to prevent further losses. Always remember, leverage is a tool, not a shortcut. Use it wisely and always trade with a plan. So, that's leverage in a nutshell. It can be your best friend or your worst enemy in trading. If you found this video helpful, make sure to like, subscribe, and hit that bell icon for more simple Forex tips. And as always, trade smart and stay safe.